Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Today, we are coming to you live, not necessarily live, but we're here in the Duquesne Innovation Studio in Duquesne Hall at the GW School of Business. Welcome back to those that are coming back, and welcome to those new people watching and listening to the episode. Today is a very special episode. We're going to talk about Berkshire Hathaway. You've probably heard about this company. This is one of our large positions in the portfolio at the GW Investment Institute, so we're going to talk about it. So just as a reminder, disclaimer, this is not investment advice. This is for educational and entertainment purposes only. Now, with that said, let's get into it. So you've heard of Berkshire Hathaway. Who runs it? You've probably heard of this person too. His name is Warren Buffett. And until recently, the co-chair of the company is Charlie Munger. Was Charlie Munger. He recently sadly passed away at 99 years old. Obviously a great run. Very sad by that. However, 99 years old, lived a full life and big contributor to building great value for that company and building a great life in general and family. So back to Berkshire. Well, Berkshire in its modern form, which is quite old at this point, was taken over by Warren, so he didn't actually found the company. The company was a textile company, and we're not going to dive deep into this episode into lots of the background. We'll mention a couple of things, but Buffett took over this company way back when, 50 plus years ago. They made linings for suit jackets, as an example, and then, they really tried to, reestablish the company's base and really, rework it, but it was a business that was not working. In any case, Buffett turned it into this holding company for himself, a publicly traded holding company. An important part to mention about that is this provides for the opportunity to have permanent capital. You might have heard us talk about permanent capital before when we had Mr. Ramsey on the episode, when you talk about permanent capital for the Investment Institute. It's important here because people cannot redeem then. And so if you're a publicly traded company, if you're unhappy, for example, with the way that Buffett is managing the company, when you sell shares, it doesn't redeem it out of their balance sheet, as an example, as opposed to a fund where you actually have to go out and sell things to make those redemptions, as an example. But in this structure, when you have a publicly traded company, Buffett has the opportunity to then manage that money on a permanent basis. And so if people get excited or nervous or overly optimistic, it doesn't have a real impact on the way that he manages it. And that's one of the great benefits to this setup in this permanent capital structure. So it's possibly sometimes an imperfect vehicle to do this money management sort of thing. But for the underlying investor, you're basically at this point getting a fund that you have no fees on. And so you buy the shares and you hold them and let Warren do his thing. But now Berkshire is a conglomerate. It owns a variety of different things, and it has holdings. Some people call it kind of the best of the S&P 500 plus with a great money manager on top of it. But they have lots of publicly traded companies, Apple being one of the biggest ones, and we've talked about that before, or is the biggest one in their portfolio. But they have other great companies that people have heard of, like Coca-Cola and American Express, that they've owned a long time. They've been recently selling shares of Bank of America, but they own big chunks of these companies nonetheless. But they also have operating companies. Insurance, as you might know, is one of their biggest operations. And Geico is probably the most public version of that. But they have other ones, and they just acquired Allegheny not that long ago, as an example. So they have specialty insurers. They have the car insurance. National Indemnity long ago was an acquisition to help build that insurance empire. And they get this so-called float. So the time between when they collect premiums and have to pay that out, they get to invest that money. And they invested in these operating companies. And as we've talked about, they bought Burlington Northern Santa Fe. And so it is a wide-ranging company with a diverse set of operations, and Berkshire Energy would be another big one. And so today we're not going to go over each one of those individually. It is important to understand that it is a collection of businesses that Buffett has been acquiring over time, and they've been buying out as much as they can each time, 100% of these companies. And some have been better than others. Geico would be an example of one that's done fabulous, and it's been a great business over time. But when you're buying Berkshire, we're buying shares in Berkshire, what are you buying? Well, one, let's just tackle the share price, because sometimes that throws people off. Now, it's nearing $700,000 per share on the A-class shares. The B-class shares are over 1,500, or to say it another way, 1,500 times a B share is an A share. And so a lot of people are not going to buy the A shares if they're not going to put that much money, if it's a retail investor, into one share of a company. But for those who bought long ago and hold those A shares, obviously it's been a tremendous increase in value. And those run pari passu alongside each other as far as the value of the total business. So let's just look at the market cap of the business. So Berkshire is the largest non-tech company out there right now. And so as of today, let's get a market cap for you. You're just shy of $1 trillion, so $981 billion market cap. So again, the largest non-tech company. The only other companies that are in this stratosphere of either $1 trillion or approaching $1 trillion are really tech companies, as an example. And this is probably the only really manufacturing insurance company conglomerate of this kind that's in this territory for that. Well, it's a very special company, obviously. And again, it's a collection of businesses. So when you're buying the business of Berkshire, what are you actually buying? Again, today's not going to be a deep dive, and we might reserve this to do at another time, a deep dive into the businesses, which probably deserves a couple of episodes because it is so diverse. It is a conglomerate. But when people think about what are you buying when you're buying the business of Berkshire, you are buying the collection of businesses that Warren has put together and his money management skills along with Ted and Todd. And we should mention that we're going to be using the framework for the Investment Institute as we do for other episodes: business, management, price, valuation, and balance sheet. So now we're tackling the business. And so the business is you're getting this collection, you're getting at no cost as far as the fee goes as compared to buying an index, but you're getting this exposure to great American businesses, and they have some exposure to international, not much, but they have some international exposure, and they've been ramping that up more recently in Japan as an example. But principally, as percentage-wise goes, you're really a U.S.-based business, so you're kind of betting on the U.S. economy, and you're getting something that's analogous, let's say, to the S&P 500, but through the lens of what Buffett has collected in addition to their money management skills. Now, that has paid great dividends over time, not actual dividends, because Berkshire doesn't famously pay dividends and hasn't for a long time. Warren wants to keep that money and redeploy it. And they've been piling up cash. And when we get to the balance sheet, we'll talk a little bit about that. So for the business, again, it's a collection of businesses: insurance, manufacturing, railroads. The Burlington Northern Santa Fe is the railroad that they own as a wholly owned subsidiary. But it is this collection of businesses, again, on top of the money management. So when you're buying that, you're getting this set. And I think a reasonable way to think about that is that you're getting the S&P 500, sort of a condensed version of that, and this curated collection of businesses that Warren has put together at hopefully favorable prices. And over time, it has worked. All right, so let's move on to the management. What else can you say about Warren Buffett that hasn't been already said? Lots and lots of things have been said about Warren Buffett. And again, sadly, until recently, Charlie Munger was the vice chair. But now you have people like Greg Abel and Ajit Jain, who runs, Greg Abel runs the operations piece, and Ajit Jain runs the insurance. And you have Ted Weschler and Todd Combs on the investment side, in addition to Buffett. So there are other people, but Buffett is obviously the star here and has put this company together over the years, again, along with Charlie, who recently passed away. And so what can we say about Warren? Well, now, he's in his 90s, so he's no spring chicken. And I think he knows that. And the succession plans are always the question mark over the last few years about what's going to happen on the management side. And so you really start to say, okay, well, Warren, obviously, will probably continue to do this as long as he can. And so, we'll see what happens there. But on the succession side, it looks like Greg Abel is set to take over with Ajit Jain running the insurance, and you have Todd and Ted on the investment side. This cast of managers has seemed to do an excellent job under his leadership. Now, none of us know what's going to happen once Buffett is gone. How will this impact the setup? Will it be the same? My personal view here, big disclaimer, is that it won't be the same. Now, it could be the same. It could be similar. But, getting these sweetheart deals as an example, because of this reputation that Buffett and Munger built over the years, will that translate to Greg Abel, Ajit Jain, Todd, and Ted? I'm not sure. Some of that might translate, but I don't think to the same degree. Now, they have built this wonderful enterprise and this great collection of companies altogether. And so I think there will be some staying power there, but I don't think it's going to be the same. I don't think that they're going to get the same types of deals, especially during pressure situations as Buffett did. Now, they might get this over time, to be clear. They can build up their own reputation once they're actually run the company themselves. So that's different. But that, I think, will take some time. Buffett has, famously said that, it takes a lifetime to build a reputation and 5 minutes to get rid of it. And this was true, and really talked about when they were having trouble at Salomon Brothers long ago. And they really had to really focus on making sure they protected their reputation. Ultimately, they did protect the shareholders at Salomon in cleaning up the mess that they had to deal with at the time. Buffett has been the front person. Obviously, these people are working day to day and making things happen. But the management team is definitely secondary to Warren right now. And so until they're really out front completely, I think it will be difficult to say, will they get the same type of deals that Buffett has over this, last 50 years? And sometimes that has made the big difference. Only a few deals. If you read one of the recent Berkshire Hathaway letters, Warren talks about, I've made a bunch of decisions that were okay and didn't really destroy us. But where we really did well was a few decisions that I made and a few deals that happened. And so that's what really drove the growth over time. And can this next group do that? Can they create those same sort of opportunities? Can they continue with this track record? I think it's very challenging to say that they're going to absolutely do that. And can they run the company well? Absolutely. But are you going to get the same type of returns? I think that's difficult to tell at the moment. And I don't think that they're going to get the same deals moving forward that Buffett did. All right. So now, with that said, time will tell on the management side. So let's look at the valuation. So this is a company that sometimes is very challenging in some regards to talk about, what's the right valuation for this? So, when you talk about what's the price to book as an example for Berkshire Hathaway, that's what most people look at. So if we dive in, to some of the ratios, people like to use PE, but PE is probably not a good thing. But, the current PE, as we talk about this in late October in 2024 is the forward is a near 23 times. And so you're a little bit below the S&P 500. But when we look at, what is actually, the price to book for this company? And, that's probably a better gauge of, this type of company, this holding company set up with these types of businesses that live in there. So, when you're talking about, what's the price to book? So anything above like 1.2 times is probably something that, you want to buy over time. And you want to say, you want to make sure that if it's trading below that, Buffett said, we're going to be buying back shares. And that's a good thing, but you could probably say that, right now it's fairly valued, right? Is it overvalued? Is it undervalued? Depends, with that metric, it's at 1.6 times right now book. And so that would be kind of high, but you could say, well, they own a really high quality collection of businesses and it should trade at a premium. And right now it is. And maybe that halo is going to be there for a while, and maybe it deserves to trade at 1.5 to 1.7 times based on the collection of businesses that they have. But it's hard to say that, it could trade, with a really high multiple, like a tech company as an example, or a software as a service company, because it really doesn't have the same type of gross and net margins. And really, it's hard to, when you think about Berkshire, it's hard to really pinpoint because it's such a collection of things. But a lot of these businesses that they own are not high gross margins and high net margin businesses. So it is appropriate to talk about price to book. But when you look at the price to book right now at 1.6 times, if it falls below 1.2, maybe they're buying back shares at that point. But at 1.6, maybe it does not make a ton of sense. But it's also very challenging to say, this is grossly overvalued. Hard to say that, right? If you've bought Berkshire along the way, you've been served very well, and you've made money over time from the increase in earnings and the earning power that's been created for those collection of underlying businesses, and that sort of bet on America and bet on Warren. And Charlie, that has worked. And now bet on Warren and bet on Greg Abel and Ajit Jain and Todd and Ted. And so it looks like, maybe this is a fair to slight premium valuation to talk about, but it's not something that I think any of us should be really alarmed about. But again, this gets back to the succession planning. What's going to happen and how might this business be transformed under different leadership? Will they start paying dividends? Will they acquire different types of companies? Will they run the investment portfolio differently than they do now? Will they have more exposure to tech? So that's some of the talk that's been said, and maybe it deserves a bigger premium when you talk about price to book, or even at some point maybe looking at a PE, but focusing on the price to book, maybe it will deserve a better premium, or a higher premium rather, at that point if its exposure to underlying companies has more tech, as an example, in it. Well, if that happens over time with a different group that's in charge, well, maybe it deserves that. And if it starts paying a dividend, you're going to attract also a different crowd of investors. When you talk about capital allocation for management, as we mentioned, it doesn't pay dividends. So that might re-rate the stock, depending on what happens, sending cash back to investors directly. And that, again, that may attract a different type of investor, retail investor that's interested in owning Berkshire Hathaway. So let's really look at now we're moving on to the balance sheet, and we'll touch on all these before we wrap up here, just to be clear on where we are on all of them. Again, the market cap, you're approaching $1 trillion. They're piling up the cash now. The cash pile is sort of enormous, and when you strip out sort of like what they're doing, you're talking hundreds of billions of dollars ready to roll for Berkshire Hathaway. And really, I mean, they have a net cash position. There is debt. They're a AAA rated company. So bulletproof balance sheet. You're not worried about that. A lot of people are worried about, okay, I think there's too much cash that's piled up in the company. And Berkshire is ready to buy things. So if they see something that's happening on the downturn, that's why they want to have all this ready cash available. However, at some point, it might be, reasonable to say, but there's better uses for that capital. So if they're going to continue to pile up that cash, investors may say, well, why don't you start sending some of that back? Now, the more tax efficient way to deliver that back has been share buybacks when they want to deliver that back, because it doesn't create a taxable event for their underlying investors. However, you might say, well, now the cash pile is getting so large, it's probably useful to start paying some type of dividends. That's a reasonable request, or a reasonable idea based on the amount of cash and the growth in earnings that continues to happen at Berkshire. And again, time will tell. It doesn't seem like Buffett is going to change his outlook on this. And so, is that going to change in the short term? It doesn't seem like it. Will it change over the next maybe 5 and certainly 10, when you talk about 10 years? Time will tell. It depends sort of when they can redeploy this. Now, because they're so large, they really, they talk about having this elephant hunting gun. It really is a big challenge to go out there and find these big acquisitions at the scale that they have and deploy this capital. So, but the balance sheet is fantastic, rock solid, AAA rated on the credit side, helps you sleep at night, all this cash. So we're not worried about that. So now let's wrap up here. And again, this was not a deep dive into this. It was a quick overview talking about the business, the management, the price valuation of the balance sheet. So let's now rate each one as we go through this before we wrap up. So back to the business. This is a collection of businesses that's been curated by Buffett. So you're betting on America. You're betting on his ability to put this collection together over time. And then the incentives that drive those businesses, highly decentralized. And when we talk about, how do you incentivize those management teams at any company, the way that it's set up at Berkshire is that, it's decentralized setup, which we didn't really touch on, which we probably should have mentioned during the management, but we'll talk about it here, is that those businesses are, set up to do well when you have this incentive structure in place where the capital allocation is centralized, but the incentives are decentralized, and these people are rewarded for the work that they do at these underlying subsidiaries. And so the business, this collection, the way that it's set up, probably an average collection of types of companies. You wouldn't say like, oh, there's these superstar types of companies in there. You certainly have some notable ones like the insurance companies in the Burlington Northern Santa Fe that, can be great companies and seize candy, but that has limited scale. So there's some things in there that you would say, well, maybe they're better than average or they're better than their industry, but you wouldn't say that they deserve this magnificent premium, for example, like an NVIDIA or a Microsoft or something along those lines. But you could say, well, it deserves better than an average. And so if you're thinking average is 5, so maybe the collection of businesses is a 7, and with the way that they've put them together is approaching an 8. So we'll kind of 7 or 8 on that. Now we go to management. I'm saying 10. Maybe I'm a little bit biased. I'm a big fan of Mr. Buffett and Mr. Munger when he was here, and still a fan now. In any case, and a fan so far of the group that's been there managing Greg Abel and Ajit Jain and Todd and Ted. But really the 10 is for Buffett. But for now, they get a 10 in my book. And again, that could be a fully biased setup, and possibly it is, but I've been a big fan over time, and I've learned a lot from Buffett and learned a lot from Munger. And so I think they'll continue to, as long as he's there, I think that's a 10. Now, the real question is, okay, when he's not there, what grade would you give then? I think that then it's still not a 10, or it's still to be determined rather, but I would not call it a 10. I think you're kind of 7, 8, or 9, trying to figure out what that is when you have more clarity on the way that the management team after Buffett, after the succession comes in, how they're actually going to run it day to day. So I think for now, that's a 10 and could be, TBD, but 7, 8, 9 for the next group. All right. Now, on the valuation, well, you could probably say that there's, again, we talked about a modest premium here to a slightly higher premium. Where does this deserve to trade? This collection of businesses, again, that's curated. And we talk about price to book at 1.6. That's high historically for them. So you could say, okay, well, maybe that's a 6 or a 7. So not fantastic on, we're not getting this cheap or anything like that at the moment. Let's say it's a, 6, 7, maybe in that range. Now let's move on to the balance sheet. That's a 10. So when you again, bulletproof balance sheet, we're all sleeping at night, not worried. So when you add all that up and you weight those individually, again, depending on where you're coming out, you're still probably talking about Berkshire as an 8 or a 9 overall, even considering some of the challenges that it has. The big questions you have to think about are the succession, which everybody's been focused on for years. And what does that mean for the type of company that Berkshire will be afterwards? We'll continue to follow this. And Berkshire, again, is one of our largest holdings at the Investment Institute. This is not investment advice, remember, so big disclaimer there. But we're delighted to talk about Berkshire, delighted to continue to learn from Mr. Buffett and learn from Charlie Munger over time. We'll continue to learn. We'll continue to invest. I want to thank everybody for their time, and we'll see you back on the next episode of Market News with Rodney Lake. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.